Okay, so moving on to the next one, investment decisions with risk and uncertainty. The previous chapter, what we calculated, is all about cash flows, present value, everything is correct. But one important element which is not considered is risk. Just because something is always profitable does not mean you should invest. So if I tell you between fixed deposit and equity shares, FD is risk free. Equity share, stock market definitely gives you more return, but risk is also there, right? So if you look at the history, somebody will tell you, had you invested 1 lakh rupees in Infosys in 10 years back, today you would have been 1 lakh, it would have been 10 lakh, you would have been crorepati. Correct. But 20 years back, 30 years back, how do you know Infos only will go today better? So if you look at the history, everything looks good. But if you start investing in now, element of risk comes. If I'll give you even more very relevant example, BCom and CA, which will give you higher salary? Obviously CA, right? But why will people do worry about doing CA? Most people even do not attempt doing CA. They easily go for BCom only because of risk. So in the capital budgeting also, mere profitability NPV is not fine. We have to adjust for risk. How to do adjustment for risk? We have certain methods. Various methods are there. I will not be able to do problem on all the methods. Let me give few theory and let me do few problems. One of them is RADR, risk adjusted discounting rate. Now, company NPV calculations, and remember one more point. This chapter is all about NPV calculations. This investment decision with risk analysis is all about NPV calculations, but we will do some modification in that process. Like here, risk adjusted discounting rate. In the discounting rate, we will do one modification. What modification we do? If the project is high, we will take higher discounting rate. If the project is having low risk, we will take lower discounting rate for same company. That is the beauty. Because for a cost of capital, for the entire company will be same, right? Discounting rate, required rate of return, cost of capital, opportunity cost, discounting rate will be same. But from a company point of view, each project may not be riskier. Reliance has got retail division. Reliance has got petroleum division. Reliance has got telecommunication division. Each division may not carry same risk. For different category, we apply different risk. Similarly, even though it is from same company point of view, for different project, you would like to take different discounting rate depending on its risk factor. How do you involve? The formula is this. RADR, risk adjusted discounting rate, is given by risk-free rates, means without any risk, what is the thing? Risk premium multiplied by risk factor. They will give it in these things in exam. Risk premium also they'll give you, risk factor also will give you. So risk premium, that is what is required rate of return of the company minus risk-free rate. Risk factor, higher the risk, when you multiply, higher will be the this answer. You understand? A project which has higher risk will have higher RADR. And what will happen to NPV? There is a negative relationship, inverse relationship. When the discounting rate increases, NPV comes down. So if the project becomes high risk, high risk, high risk, NPV will be falling, falling, falling. Even after that NPV is positive, it's worth taking. So risk adjusted, even after taking the risk into consideration, it is worth taking the project. So that is called as RADR. And yes, it sounds very similar to the formula we have learnt in CAPM, RF plus RM minus RF into beta. Very similar formula. You can connect this to remember. So only this discounting rate will change. Otherwise, we will simply compute NPV, and wherever NPV is highest, that project is selected. Any doubt on this part? Okay. Risk factor is beta coefficient. Risk factor can be anything. One of the risk factor is beta. Many people will have different risk definition. Definitely beta represent risk. So beta also can be used. But if you want to use something else, that also can be used. That left to the management for the company to define how much is the risk factor. If you use CAPM, that is beta is the risk factor. In CAPM, beta is for risk. Here, they can use anything depending on management decision in the exam, whatever they have given. Hope it is fine. I have not done any problems on this. This is just to tell you the theoretical aspect. Okay, I'll go further. Next, we have certainty equivalent approach. Certainty equivalent means to what extent your cash flow is guaranteed. Imagine you write the examination. Once you come out of the exam hall, somebody asks you, how was the exam? How much marks you get? Of course, a CS student, I don't expect any answer, because the position of a CS student is very similar to the position of a doctor. No, after operation is over, what will doctor tell? I tried my level best. The rest is up to the God. So I'm just asking for a regular exam. Let's say 10th standard. Some exam happens midterm. Somebody asks, how much will you get? You will be like, I'm sure I will get 60 marks. Beyond that, I'm doubtful. Some answer I'm not sure. But 60 marks, I'm very confident. We use these kind of conversations, right? Similarly, in projects also, the managers will tell like this. From this project, we are starting a hotel, we are starting a restaurant. Based on my analysis, I'm expecting every year a cash flow of 10 lakh. Out of that, 60% I'm very confident. It will happen minimum, I'm sure. Balance 40%, I don't know. So, what is your guaranteed portion where your confidence is certain? That is certainty equivalent. So, if I tell you certainty equivalent is 0.8, it means for 1 rupee estimation, 0.8 is certain, guaranteed, confirm, full confident. Balance 0.2 rupees, it may come and it may not come. So what do we do in NPV calculation, project evaluation? You're confident up to what? 0.8. Take only those cash flows. Do not even consider uncertain cash flows. Let's take the cash flows which are certain, which are guaranteed. Let's do present value of that and see if NPV is positive. If yes, without even considering variable cash flows, my NPV is positive, good, accept. If not, it's risky, let's not accept it. So we are able to bring in the risky element of risk into NPV calculation. So NPV will be same format, present value of cash inflows minus investment. But the cash flows, what I take is certain cash flows, which is whatever estimated cash flow multiplied by certainty equivalent factor. This certainty equivalent factor will be given in the question. Basically, higher certainty equivalent means higher confidence, less risk. And lower certainty equivalent means lower confidence, high risk. And many people confuse this with probability. No, this is not probability aspect. This is just, so when I say 0.75, That means if cash flow is 1 lakh, how much cash flow? Let's say 1 year first cash 1 lakh, 1 lakh into 0.75. I will select 75,000. Balance I completely ignore it. I don't even consider. So calculation of NPV based on guaranteed cash flows, certain cash flows, is called as certainty equivalent approach. And certain cash flow is calculated by the estimated cash flow multiplied by certainty equivalent, represents confidence level, certainty level, that will be given in the question. Thereby we are not considering the variable cash flow, uncertain cash flow. Therefore, since the cash flows are risk free, our discounting rate also risk free. Keep this in mind. Both should be matching. If the cash flow is without risk, our discounting rate also should be without risk. In the previous method, what I discussed, RADR, in the discounting rate, I added element of risk premium into risk factor, I've added. So in cash flow also, element of risk will be there. I mean, cash flow, risk element is there. Discounting rate, risk element is there. Here in cash flow, I am taking out the risk element. Similarly, in the discounting rate also, I should take out the risk element. Discounting rate for this approach should be risk-free rate. Apart from that, this is also about NPV calculation. NPV positive, accept the project. NPV negative, reject the projects. So this also, I don't have any problem. You have any doubts? You can ask. Or else I'll go to the next concept. Okay, I believe it's done. I'll go to the next one. I hope no questions are there. Next concept is there with probability. I will explain with the problem. I'll explain the concept. So come to the problem. A Limited is considering two mutually exclusive projects, X and Y. You have been given the following net cash flow probability distribution of each project. Compute the following: expected net cash flow for each project, variance for each project, standard deviation from each project, coefficient of variation for each project. Identify which project do you recommend. Give reason. Okay. First, let me tell you the calculation format of this one. Then we'll solve it. Let's take project X for example. Your cash flow 50,000, probability is 0.3. Your cash flow 60,000, probability is 0.3. Your cash flow 70,000, probability is 0.4. In general, we have something called as measures of central tendency, nothing but average. If somebody asks you how much you scored in 10th standard, you tell 80%. But you scored only 80%. 6 subjects were there. How you can score 80 in 6 subjects? It's possible in CA, but in 10th standard now very difficult. 80 marks, all 6 subjects put together. No, in each subject you scored 80. But how come you scored 80 in each subject accurately? No, on an average. Which means this average represents many number. So one subject number, second subject number, third subject number put together, we do an average. That's what this average marks or mean we call it. Similarly, look at this project X. Your cash flow can be 50,000, your cash flow can be 60,000, your cash flow can be 70,000. We have many numbers, depends on situations. Good, right? Like if economy is good, I'll get 70,000 cash flow. You get good job. You can think from individual point of view. If economy is bad, 50,000 will come. If economy is moderate, 60,000 will come. Right? You can also tell, right? If the question paper is difficult, I'll score about 40 marks. If question paper is easy, I'll score 100 marks. If question paper is in between, I'll also score in between around 80 marks. Different situations, different possibilities. And then I want an average. I don't take a simple average. I would like to consider its chance, its probability. So what's the format is going to be? When we want to calculate the average, one column will be X, like cash flow here. One column will be P, probability, which they have given. And I want an average means I will do X into P. The product, what I get is X bar, average. You can also call it as E of X. Some people say expected value of X, E of X. This will give you average. Now we want to understand how the values are different, deviation, risk. For that we calculate standard deviation. The formula for standard deviation is given by summation x minus x bar the whole square multiplied by p square root. Let me explain with the logic, you understand. Now I want deviation. X bar is average. I want deviation from average. So x minus x bar, individual value. Positive means above average, negative means below average. Then I will square this number. Then I would like to apply the weight, means I'll multiply it by probability. Since I squared earlier, now I would like to take a square root. Logical formula, square root of summation means total of x minus x bar whole square, deviation square multiplied by p. So what are the columns required? One column I require for x minus x bar, deviation. One column I require for x minus x bar whole square, squaring it, then x minus x bar whole square multiplied by probability. This total will give me basically variance, the summation x minus x bar whole square into p. If I do a square root of this, I will get the standard deviation. So x bar will tell you what is the average, whereas standard deviation will tell you what is the variance, what is the movement, what is the risk. For example, I'll give a stock market example. Okay, some stock A, average return you can expect 6% based on history. Stock B also you can get 6% average, but 6% you get for stock A plus or minus 1%, for B plus or minus 5%. Now can you tell me which is more risky among the stock A or stock B? You will get 6% plus or minus 1%. Range is that. Stock B, you get 6% return but plus or minus 5%. It can be 11 also, it can go down to 1% also. Now, can you tell me which stock is more risky, where the movement is high, where the range is high? Stock B, correct? Because higher, I mean, this plus or minus what you're doing, no, that is what is standard deviation. So when the history, when you look at it, we take an average X bar, but I want a range. Within what range I'm likely to be there, plus or minus, I will say standard deviation. Higher standard deviation means higher risk. Low standard deviation means lower risk. Okay, so I will do for project X. Later, you can do for project Y. But before that, you can write the formula quickly. For standard deviation is square root of summation x minus x bar whole square multiplied by p. If I don't put the square root, or if I just square this, then that is called as variance. They was both. We have to calculate variance also. We have to calculate standard deviation also. Any questions? Conceptually, if you have, you can ask. Else, I will go for numericals on this problem. Okay, no questions. So I'll go for numericals on this. So project A, I will do it. Then I'll give you the time to do the project B part. Project X, cash flows they have given 50,000, 60,000, 70,000. Please write along with me. X column 50,000, 60,000, 70,000. If you believe this 1,000 is a difficult one, you can make 50, 60, 70. You can save some time. Probability given 0 0.3, 0 0.3, 0 0.4. Okay, let's multiply 50,000 into 0 0.3, 15,000, 60,000 into 0 0.3, 18,000, 70,000 into 0 0.4, 28,000. Okay, that is what is total. That is what we say x bar. You can also say expected value, E of x, expected value. Both are same. X bar, E of x, average, all are same. Okay. Then x minus x bar, deviation. X value 50,000, x bar 61,000. So x minus x bar 50,000 minus 61,000. minus 11,000. Similarly, 60,000 minus 61,000 minus 1,000, 70,000 minus 61,000, 9,000. Square this number, 11,000 square, 12 crore 10 lakh, 1,000 square 10 lakh, 9,000 square 8 crore 10 lakh, and okay, write down these numbers, big numbers. As I told you, to save time, you can just make it as 50, 60, 70, and thousands. You can solve that. Okay, then multiplied by probability. So 12 crore 10 lakh multiplied by zero point 0.3, 3 crore 63 lakh, then 10 lakh multiplied by zero point 0.3, 3 lakh, 8 crore 10 lakh multiplied by zero point 0.4, 3 crore 24 lakh. Total, this is what summation x minus x bar whole square into p, which is basically variance. I can say if I take a square root of this, I'll get standard deviation. This is for project X. I'll give you 2-3 minutes. Can you try for project Y? Similarly, same set of columns for project Y. If you have any doubts, you can ask. And once completed, you can let me know. Project Y. Okay, is it done for project Y? Done? Okay. So if you have done it, please compare it. See if you're able to get these numbers. You should get this number 24 crores 40 lakh. This is summation x minus x bar whole square multiplied by p. Now let's calculate what they've asked for each project. Expected return means mean x bar. Expected cash flow x bar. 61,000 for project X, 1,04,000 for project Y. Variance, which is what we have got here, 6 crore 90 lakh, 24 crore 40 lakh. If I take a square root of this, I get standard deviation, square root of variance, square root of summation x minus x bar whole square into p, and variance is the same thing directly. Summation x minus x bar whole square into p is variance. If I take a square root, I get standard deviation. So write down these three. Okay. Next, they've asked coefficient of variation. Coefficient of variation formula is given by standard deviation by mean into 100. So we can express the variability in percentage terms. Standard deviation by mean into 100 is called as coefficient of variation. Standard deviation 8307 by mean 61,000 into 100. Standard deviation 15,620 by mean 1,04,000 into 100. Gets 13.62%, 15.02%. And what they've asked, which project would you recommend? Wherever the cash flow should be high, mean should be high, risk should be less. So mean is high, 1,04,000. Risk is also high. So if I compare coefficient of variation, this is what is, we say 15.02%. So this is high risk and this is low risk, 13.62%. So based on the COV, based on the variation, based on the consistency of cash flows, project X is recommended. We can also say this is like risk per rupee. Okay, this is like risk per rupee because standard deviation by mean, numerator standard deviation risk, denominator mean. So that is the return. So here 13.62 means risk of 13.62 for return of 100. Whereas for project Y, risk of 15.02 for return of 100. So which is high risk for same return? Project Y is high risk. Therefore, project X recommended. So you can write down project X recommended. Why? Because it provides lower risk for the same return. Risk of 13.62 for return of 100, whereas for project Y, risk of 15.02 for return of 100. So let me know once it's done. Done? Okay, good. So I'll go further to the next concept. Sensitivity analysis. Let me explain the concept, then I'll take up the problem. Sensitivity analysis. Sensitivity response. When certain variables change, how the business will respond. So for example, you are having your friend and you have mobile phone. If your mobile phone is falling suddenly, how do you react? As if your heart is falling. Your mobile phone is falling. If your friend is falling, you it's an entertainment. You call everybody, see he's falling. The way we respond, the way we have sensitivity is different. For something we react more. For something we react less. See, now some news comes. US dollar appreciated against rupees. USD becoming costlier. You're not worried. Petrol price increased by 10 rupees. You're worried. So you understand, right? Your sensitivity is more towards petrol price. Your sensitivity is less towards USD. But if it is a Infosys who is having all their revenue cash flow in dollar terms, their dollar fluctuation they are more worried. Petrol price they are not worried. So different business will react differently for various factors. So as a project manager, as a CFO, CEO, he has to understand which is the most sensitive factor. If that factor change, my business is severely affected, positively or negatively. We would like to measure that, so that once I measure sensitivity, if some factor is very sensitive, for example, selling price is very sensitive. If I change my selling price, my overall profitability is severely affected. I don't want to change selling price. Or should I concentrate on my fixed cost more? Or should I focus on number of units more? So to understand which factor is more sensitive, we will do this analysis. We are going to calculate sensitivity. One simple example I will calculate, let's say. Okay, simple example. Suppose, you can also write down this example. Sales is 1 lakh and variable cost is, let's say, 60,000, which means you have profit of, or no, assume no fixed expense, no tax, no depreciation. This itself is your profit. This itself is your cash flow of 40,000. Simple one, cash flow of 40,000. Okay, now let's say discounting factor, discounting rate is 8%, and number of years, project life, for simplicity's sake, let's say 3 years, and investment, let's say 1 lakh. Now, can you calculate for me, first of all, what is NPV? I hope you are able to calculate directly now. Cash flow is 40,000 into, NPV is present value inflows minus investment. Inflows 40,000, directly multiplied by annuity factor. I'm not writing any table. Hope you understand. At 8% for 3 years. So 8% for 3 years. I think 2.5771 minus investment. Investment 1 lakh. So 40,000 into 2.5771 minus 1 lakh. 4 decimals I'm taking. 3084, right? 3084. 3084. Okay, this is our present NPV. Now let's talk about variables. Okay, let's talk about variables. Let's take up sales. Now sales is affected by 10%. For example, let's say sales affected by 10%. Or let's say this is selling price also I will give you for safety sake. Selling price, let's say this is 1000 units into 100 rupees, and variable cost 1000 units into 60 rupees. Anyway, selling price affected by 10%. Doesn't matter actually. Okay, ignore this. Just say that selling price affected by 10%. Okay, just say selling price affected by 10%. Now, what will happen to the new sales? Can you tell me now? What will happen to the new sales? 1 lakh sales affected by 10%. So it will become 90,000 now. So what will happen to the NPV? Instead of 1 lakh minus 60,000, I will do 90,000 minus 60,000. 10% affected into, as a annuity factor, 2.5771 minus 1 lakh. I'm writing it directly. Hope you understand. This will come to 90,000 minus 30,000 into 2.5771. Okay, negative number comes. A negative number is also fine, but for example purpose, I would like to give only positive numbers. So just make this as 60,000. Investment, make it as 60,000. So this NPV will be how much? 43,084. And this NPV, I'll just make it as this number as 60,000 NPV. So I just want to explain a positive number only for that purpose. 17,313. Okay. So what is the NPV changed by? Sales affected by 10%. So what is the NPV change? Change in NPV. 43,000 became 17,313. So 17,313 minus 43,084 minus reduced. But in percentage terms, divided by 43,084. In percentage terms, how much do we get? 59% change. 59.82 minus 59.82%. Okay, now here we understood if sales is affected by 10%, your NPV will be affected by 59.82%. This is the one level of sensitivity. Now, similarly, if I say variable cost is affected by 10%, same percentage, then let's see what will happen to the NPV. Please confirm, have you taken down till here? Then I'll do a summary. You will understand better. Can I go to the next slide? Sales 1 lakh means what? 1 lakh sales was there, affected by 10%. So 10% on 1 lakh is 10,000. So I took 90,000 as sales. Hope you got that one. Okay. Now, just like sales, if variable costs affected by 10% means what? Variable cost change. No, sales you keep it same. We can't change everything. Right? Sales you keep it as 1 lakh only. Don't change the sales. Variable cost is changing now. So variable cost affected by 10%. So what will be the NPV now? What will be the new cash flow? Sales will keep it as 1 lakh minus variable cost 60,000 affected means increase, cost increase 60,000, 10% means 6,000. So how much it will become? 66,000. Correct? 66,000 multiplied by 2.5771 minus investment 60,000. So 1 lakh minus 66,000 into 2.5771 minus 60,000. 27,621. So what is the change in NPV now? It became 27,621 from 43,084 divided by 43,084 into 100. Minus 35.89. Original investment taken as 1 lakh. I asked you to change it, right? Original investment. I asked you to make it as 60,000, make it as 60,000, make it as 60,000. Original investment, I asked you to change it everywhere. I asked you to change the numbers itself everywhere. Is it fine? Any doubts still here? Let me just compare now. So what we have just done so far, let me just do a quick comparison. The variable, the change, and the change in variable and change in NPV. So we have taken sales, we have taken variable cost, change in variable sales, we have taken down by 10% or 10% change. NPV changed, affected by how much? 59.82%. And variable cost, we took 10% change. And how much variable cost affected NPV? It changed by 35.89%. Now, both are affected by 10%. Sales also changed by 10%. Variable cost also changed by 10%. But to which factor NPV reacted fast? Where NPV reacted too much among the two variables? Sales, right? 59.82. So comparatively, sales is sensitive. So between variable cost and sales, priority wise, sales come first. Second priority, variable cost. So sales should be closed, monitored more closely. So which factor is most sensitive? Those factor can be given importance. Sales management, sales force, marketing people, they will be given first priority because it is more sensitive. I hope you understood the uh, meaning of sensitivity analysis. This is one method. There is one more method. I'm going to tell you that as well. First, you write down these things. Okay. This is one method where if the variable changes, how the NPV changes, and wherever NPV reacts fast, that becomes more sensitive. Now there is one more method. We can say acid test method or liquidity method, insolvency method, whatever we can call it. Now you please tell me, think from a business point of view, think from this project point of view. If sales changes, sales affected, you're worried up to what stage? I mean, till what point you're not really worried? Only after a beyond point you start worrying, where project becomes non-profitable. When will you reject the project? When will the project becomes non-profitable? When NPV becomes negative, right? Up to NPV positive, we don't worry. But if NPV becomes negative, that is where the project becomes worrying. So what do we say? Let's do one thing. What is the change that will take place which will make NPV zero? Up to what stage we can go ahead? That is one more method. Now let me do that method for you. What is the selling price? What is the sales which makes NPV zero? Which makes NPV zero. So let's make the formula. NPV should be equal to zero. Let's assume sales as X. Let's assume sales as X minus variable cost. Same variable cost, 60,000 into the annuity factor, 2.5771 minus investment. I asked you to change it, mind it, 60,000 as NPV as 0. Simplify. 60,000 goes to right side. X minus 60,000. This 60,000 goes to right side and 2.5771 comes below. 2.5771. 23,282. Then the 60,000 goes to right side. 60,000 plus 23,282. So it should be 83,282. Basically what? If sales becomes 83,282, NPV will become 0. So let me do one thing. What is the change in sales percentage? Change in sales is 1 lakh becoming 83,282. So 83,282 minus 1 lakh divided by 1 lakh into 100. 16.72% minus. So if sales is down by 16.72%, NPV will become 0. Similarly, can you do the other one? What is variable cost? What is variable cost which makes NPV 0? Same format, can you follow? Sales, you take it as 1 lakh. Variable cost, you take it as X into 2.5771 minus 60,000 equals 0. Can you tell me what will be the value of X? Can you simplify? 76,718. 76,718. Hope you are getting it. And what will be the change in variable cost, percentage terms? 76,718. Change in variable cost percentage. 60,000 became 76,718. So 76,718 minus 60,000 divided by 60,000 into 100. 27.86. Okay. Now, so this is one more way of analyzing sensitivity analysis, which making NPV 0. So if you have done till 10, if you are done till here, tell me. I'll go back to the previous slide. I'll do the summary part. Okay. I'll go back to the previous slide. I'll update the summary part now. Now, please tell me, in this case, sales changed by how much percentage in our calculation? Sales changed by 16.72%. Okay, sales changed by 16.72%. Now, can you tell me how much NPV is changed by here? If sales change by 16.72%, NPV becomes 0. NPV 0 means what percentage? NPV will be down by how much percentage? So much difficult? Yes, 100%, right? Everything gone, evaporated. 100%, yes. NPV is down by 100%. If sales is down by 16.72%, NPV is down by 100%. Similarly, if variable cost increase by 27.86 percentage, NPV will be evaporated, will be down by 100%. Okay, now which is more sensitive here? 16.72% is more sensitive or 27.86% is more sensitive. Don't blindly think whichever is high, whichever is less. Think logically. Which will cause a small change will have a big impact. Sales down by 16.72%, NPV done. Whereas variable cost 27.68 percentage. So small change is fine to evaporate variable, to evaporate NPV. So this one small, this is more sensitive. See, when you follow the first method, you follow 10% change approach. You choose whichever is high. But when you follow the second approach, uh, where you have taken NPV as 100%, here you select whichever is less. Be careful about which you select. Okay, you can also do ratio basis actually. What is the ratio wise if you do? 59.82 divided by 10, some 5.9 times. 100 by 69.72, you get same 5.98 times. Or 35.89 divided by 10, some 3.589 times. 100 by 27.86, same thing you get. Basically, when the sales changes, how much NPV will change. Ratio wise, we can also go for it. Anyway, those things and all, don't worry. So in the exam, if you follow 10% method, then sensitive factor will be whichever is higher. If you follow this liquidity test method or acid test method, where you make NPV 0, then you choose whichever is lower as the most sensitive. Which method to follow? If the question is silent, you can choose any method. Did you get this one? Methods? Okay. Which one you like it? The first method where you change a 10%, or you like the second method where we assumed as x and we solved and then we calculate the percentage? Okay. So some of you might have the first method, some of you might like the second method, whichever is comfortable, you follow it. Now, I'm going to tell you one more small point. After that, you tell me which one you are comfortable with. Okay. Now, let me do a summary now. Okay. So, what is our NPV? What we calculated? NPV we calculated originally 43,084. Correct? 43,084. Now, this NPV should become 0. Now tell me, if NPV should become 0, how much NPV should reduce by? I'm asking a silly question, still I'll ask you. Our NPV 43,084. This should become 0. Now this NPV should be reduced by how much? Not percentage, I want amount. 43,084 should become 0. 43,084 only, no. 10 rupees should become 0 means down by 10 rupees. Okay. It should be down by 43,084 rupees. Okay. Now we are worried about sales. Sales should cause it. Now can you tell me this? Listen to me this question carefully. This will help you a lot conceptually. If sales is down by 10 rupees, can you tell NPV will be down by 10 rupees? I'll tell once more. If sales down by 10 rupees, can I tell NPV down by 10 rupees? What do you think? No. Why no? Because sales comes every year. NPV is present value, right? You can't compare it. You can't compare. To make it comparable, what should I do? To make it comparable, I should adjust NPV. I should adjust annuity factor, time value of money. Correct? So, what should I do here? My sales should be down by 43,084 means this if I multiplied by annuity factor, or actually I should not multiply, I will divide by annuity factor. This is my annual sales. Sir, what is that? I'll tell you. Listen to me carefully. From the annual cash flow, remember year 1, year 2, year 3, we had cash flow, same cash flow, and we brought it into present value. Can you tell me what I did to get the present value? For the cash flow, what do I do to get the present value? I multiplied by annuity factor. So cash flow, when I multiplied the annuity factor, I'll get present value terms. Now for if I go reverse, what will happen? Present value, if I want to come to cash flow, tell me what to be done. Simple maths. I have annual cash flow. I want present value. I will multiply. I have present value. I want cash flow. What should I do? Reverse. I should divide. So, if my sales should reduce by 43,084 because of NPV, so I should do 43,084 divided by 2 point, what is annuity factor? 2.5771. How much you get? Sales should be reduced by 2.5771. 16,718. This is your annual reduction in sales. And what is your annual sales? 1 lakh. So what is the percentage? 16,718 divided by 1 lakh into 100. You got same rate, 16.772%. Same number that we got earlier. Okay. Logic I told you. Now forget everything. I'll give you the direct shortcuts. Sensitivity shortcuts. You can use this in exam also. Sensitivity shortcuts. Okay. Selling price sensitivity. What you're going to do is this. NPV divided by present value of sales. That's all the formula. What is NPV? 43,084. What is present value of sales? We are calculating sales. Sales is 1 lakh multiplied by what is annuity factor? 2.5771 into 100 if you want to express in percentage. Tell me what answer you get. Same answer are you getting? 43,084 divided by 1 lakh divided by 2.5771 into 100. 16.72% only. Did you understand the logic? Simple formula. Nothing to worry. NPV divided by present value of sales. Because you're calculating selling price sensitivity, denominator present value of sales. Now, if I tell you what is variable cost sensitivity, variable cost sensitivity, numerator NPV, what will be denominator? Present value of variable cost into 100. That is NPV is 43,084. Present value of variable cost. Variable cost, I think I took 60,000 into 2.5771 into 100. 43,084 divided by 60,000 divided by 2.5771, 27.86 percentage. Then you choose whichever is lower. Therefore, it is more sensitive. Isn't it? You can able to do it in 2 minutes. No need to assume X. Compute the percentage. Assume 10% change. What will selling price will happen? What variable cost will happen? Nothing doing. Just use the shortcut formula. You'll get the answer in 2 minutes. Sir, you could have told this earlier only. Why you wasted our last 1 hour? The two in crash course. But in the exam, if they ask you, compute NPV, if sales change by 10%, this shortcut you can't use. Compute selling price at which NPV will become zero. If they ask you specifically, you can't use this shortcut. So that's why I discussed in detail. But if they just ask you, compute selling price sensitivity, this one formula, 1 minute, you're done. You can do this in exam also. Now, can you tell me if some formula is there, fixed cost sensitivity, numerator NPV, denominator, can you tell me what should I write? In this problem, fixed cost not there, but if fixed cost was there, imagine. For selling price, I took present value of sales. For sensitivity, for variable cost, I took present value of variable cost. If it is fixed cost sensitivity, what will I do? Denominator. Tell me. Present value of fixed cost, as simple as that, right? Present value of fixed cost into 100 over. Like that, I can also do initial cost sensitivity, initial investment sensitivity. Now, can you tell me what's the formula for that? I'll take out this part. Hope this you are able to write it easily. Now, let me write initial cost sensitivity. If they ask you, initial cost sensitivity. Numerator NPV. What is denominator? Initial cost or initial investment? Denominator. Don't tell me present value of initial investment. Initial investment itself is present value. You get it? Sales we did present value. Variable cost we do present value. Fixed cost we do present value. Initial investment no present value. Initial investment is today itself is present value. So NPV by initial investment into 100. And if you want one more secret, I'll tell you. Not required for exam. One small secret. This NPV by initial investment is there. No, that is same as profitability index minus 1. You know PI, we discussed previous chapter. If I take out minus 1, you get exact the same number. You can try it in other problems. Just for your information, I'm telling you. From the profitability index, if I subtract minus 1, I get initial cost sensitivity. Okay, fine. So this is about sensitivity. We have to do problem, and we have one more inflation impact also. That will take a break, and then we'll go further. But any doubts? I hope in the exam, if they ask you simply since compute sensitivity, please follow this method. You can solve it in less than 5 minutes. No hustle, no complication, no worry about getting any errors. NPV by present value, simple formula, NPV by present value. Because NPV present value terms. Okay, so I believe no questions are coming. I hope you liked this method, this shortcut. It's a conceptual one, so you can present in exam also. Okay, so no questions are coming. Let's take a break. 1 o'clock now, 1:05. We can do problem on this before break. No, I don't want to. I mean, again, if I do one problem, then only one problem left. Inflation will be left out. I feel like I'll be doing that also. That is why. Your answer is different in variable cost. How? 27.861 only, right? We got. How you got different answer? Where you got? You got different answer in this method, 27.86 percentage, or in X method. You're not able to get this number 27.86. Which one should I explain? This X method or this shortcut method? NPV 0. This X method, right? Okay, let me see why you're not getting it. Please check it out. Did you get 76718? You're not got? Okay. I think that's what you should get. So please check it out. This 60,000 goes to right side. That becomes plus 60,000. Then divide by 2.5771. 60,000 divided by 2.5771. You get 23,281. For that, then this 1 lakh will be there. This 23,281 will come to left side. So you subtract from 1 lakh. So from 23 to 81, subtract that from 1 lakh, you get 76,718. Are you able to get it? I'll explain once more. 60,000 goes to right side, becomes plus. 2.5771 you divide, that will give you 23 to 81. Then 1 lakh is there, 23 to 81 is there. 1 lakh you bring it to left side, minus x you take it to right side. So 1 lakh minus the 23,000 will give you 76,718. Okay, so please check that out regarding calculations. So the problems on this one and sensitivity analysis will take after the break. So 1:07, 1:10 now. Let's meet at 2:10. Let's take a break of 1 hour. Let's meet at 2:10 and we'll continue with this chapter and then working capital afterwards. So take a break of 1 hour. Let's meet at 2:10. Same link, okay, 2:10.